Lemonade shares jumping after the low-cost insurer reported a smaller loss than expected. The fintech giving shareholders encouragement about cash flow and the role AI is playing in its business. Lemonade CEO Daniel Schreiber joins us before the conference call, which is scheduled for tomorrow morning. Daniel, great to have you with us.
Great to be with you. Thank you.
The stock is up 8.5%. I'm just wondering, in terms of offering low-cost insurance, you're not making money right now. So are you just sort of eating the cost in order to gain market share versus competitors?
No, not at all. Every policy that we sell by law has to be profitable. So the marginal profit is significant. In the results that we just published a few minutes ago, we said that not only is our book growing, which speaks to what you just asked me, but also our gross profit has grown dramatically. In fact, we've more than doubled our gross profit year on year, and our losses are therefore shrinking. They shrank by a third in the results that we just published. So you're seeing us sell more and more products, all of them marginally profitable. The more we sell, the more profitable we get, and we expect to break into cash flow positivity before the year is out.
Can you talk to me about the guidance that you issued for Q2? Because it does look, on the surface at the very least, that it is below what the street was expecting in terms of revenues as well as your EBITDA loss.
Yeah, so we've actually raised guidance for the year across all key metrics. So everything is entirely on plan. But during Q2, we do intend to continue to invest in growth, perhaps more than the market expected. So we've been not merely growing fast, but accelerating growth. We went from 18 to 19 to 20 this quarter, 22%. We're going to continue that trend line all the way up into the higher 20s throughout the year and hopefully higher than that beyond. So this is all part of the plan. We need to grow into profitability. Insurance is not a business that is profitable at subscale levels. So growth is a key condition to that profitability that we expect to get to, as I say, before the year is out on a cash flow basis.
Mr. Schreiber, it's Karen Feinerman. Thanks for being on today. So we hear a lot about other insurance companies really sort of stepping back from offering some products and just being unable with some of the extreme weather situations to know what they're underwriting. And so are you able to cherry pick, or how is it that you feel comfortable expanding your business?
Hey, Karen. So the founding thesis of Lemonade was very much in line with your question or the premise behind it, which is that you build an insurance company from scratch on a digital substrate using AI as a foundational tool. And we've been doing that since 2015 when we founded the company. Things are going to look different. And insurance is a business that is all about pricing and selling probability theory. It's statistical. So machine learning and the tools of modern technology are really transformative for the foundations of insurance. So yes, where other insurers see crude groupings of policyholders and are unable to see the nuances between them, we have orders of magnitude more insight, almost X-ray vision relative to incumbency, and therefore ability to price differentially and choose who we underwrite with far greater precision, perhaps, than the industry is used to by historical standards.
How much better does your profitability get as AI improves? And what sort of trajectory do you look at in terms of the improvement of AI that you need to see in order for it to actually impact your
and how much does it cost you to get there? Because I think the street's worried about that.
Mm-hmm.
Yeah, so we've already seen or been able to demonstrate quite a lot of it. Just this quarter, we announced, as I say, 22% growth, but an 11% decrease in headcount. Our OPEX is unmoved in 2 years, even as we've doubled our book. So you are seeing in the number the dramatic impact of the automation that AI has done for us. 98% of our policies are sold by AI. 50% of our claims are handled start to finish without any human intervention whatsoever. Consumers, of course, delighted. They get a claim paid in 3 seconds. They're not missing the human, but the costs just absolutely collapse. And we're seeing that in our numbers, as I say, doubling the business in 2 years, trebling the gross profit, whereas OPEX not moving an inch over those same 2 years.